In this video, we're going to be performing a deep dive on automatic data processing's dividend safety. To begin, let's talk about ADP's business model. Automatic data processing is one of the largest business services outsourcing companies in the world. The company provides payroll services, human resources technology, and other business operations to more than 700,000 corporate customers. ADP was founded in 1949 and currently trades with a market capitalization of $57 billion. Automatic data processing is a well-known dividend stock because of its compelling track record of dividend growth. With 44 years of consecutive dividend increases, automatic data processing is a member of the Dividend Aristocrats Index, a group of elite dividend stocks with more than 25 years of consecutive dividend increases. Looking ahead, investors cannot rely on ADP's dividend history alone to measure its dividend safety. For the remainder of this video, we will discuss the company's current dividend safety from four perspectives: its dividend safety in the context of its current earnings, its dividend safety in the context of its current free cash flow, its dividend safety in the context of its recession performance, and its dividend safety in the context of its current debt load. First, let's discuss automatic data processing's dividend safety in the context of the company's current earnings. When automatic data processing announced its most recent financial results on October 31st, the company reported that it generated earnings per share of $1.20 in the 3-month reporting period. For context, automatic data processing paid a 69-cent dividend during the same quarter for a dividend payout ratio of 58%. Looking out over a longer time frame, our conclusion is the same. Automatic data processing's management team has provided guidance for adjusted earnings per share of about $5.25 in the current fiscal year. The company's current dividend of 79 cents per share implies an annual dividend payout ratio of just 60%. Using earnings, automatic data processing's dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. With that in mind, we will now measure automatic data processing's current dividend payment to its free cash flow. In the most recent quarter, automatic data processing generated $149.2 million of cash from operating activities and spent $43.2 million on capital expenditures for free cash flow of $106 million. The company distributed $302.6 million of common share dividends during the same time period for a free cash flow dividend payout ratio well above 100%. On the surface, this may be alarming. With that said, some additional investigation reveals that this short-term inability to cover dividend payments with free cash flow may be related to the timing of cash entering and exiting the business. In fiscal 2018, which ended on June 30th, 2018, automatic data processing generated $2.5 billion of cash from operating activities and spent $206 million on capital expenditures for free cash flow of $2.3 billion. The company distributed $1.1 billion of common share dividends during the same time period for a fiscal year free cash flow dividend payout ratio of 48%. Using free cash flow, our conclusion is the same as when we use earnings to measure automatic data processing's dividend safety, although a second-level analysis was required. Overall, the company's dividend appears very safe for the foreseeable future. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. With that in mind, this section will analyze automatic data processing's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by assessing its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Automatic data processing's performance during this time period is shown here. As you can see, automatic data processing's earnings per share continued their streak of uninterrupted increases during the 2007 to 2009 recession. With that in mind, we have no concerns about the company's ability to pay rising dividends during future economic downturns. The last angle that we will use to assess automatic data processing's current dividend safety is by looking at the company's current debt level. More specifically, we will see how much the company's weighted average interest rate will need to increase before its free cash flow will no longer cover its dividend payment. In fiscal 2018, automatic data processing generated $102.7 million of interest expense and had total debt outstanding of $2 billion for a weighted average interest rate of 5.1%. The following image shows how changes to ADP's weighted average interest rate would impact the company's dividend coverage as measured by free cash flow. As the image shows, ADP's weighted average interest rate would need to rise well above the 25% level before its dividend would no longer be covered by free cash flow. With that in mind, we believe that the company's debt level is unlikely to impact the safety of its dividend moving forward. Thank you for watching today's video. which performed a deep dive on ADP's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover SureDividend's investor education efforts. If you are interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.